Trideep Bhattacharya will join us now to talk more about markets and the way they are approaching investing. Trideep, very good afternoon. Thank you so much for your time. Nice
Very good
haircut, I
afternoon.
must say, looking sharp. Market also had a very quick and sharp haircut on Tuesday, but then rebound equally sharply, barely giving anybody to deploy extra capital, which was sitting on the side. I want to understand from you that the way messages from the government side of continuity and all the five most strategic and core kind of ministries were retained by BJP. So there was no compulsion of a coalition kind of politics displayed when the portfolio allocation was happening. Is market really taking heart? Because market up till now has really liked the work done by our external affairs ministry, finance ministry, even oil and gas for that matter, on various stuff.
I would actually, thanks Ajay, always good chatting with you. I would say that the results of elections this time have been, sensible rather than sensational. And that's the direction of, policy direction going forward as well. I think the market has taken comfort over the last few days since the election result has come out until yesterday that the ministries have have been announced, that broadly speaking the policy directive is likely to remain the same. And given that people who had done good work, the previous regime have been given the second chance, also shows that to a certain extent from market standpoint, uncertainty is not likely to be very high. The next important signpost, of course, for the market would be the 100-day plan and, of course, the budget, which will show us the way forward. But I think all indications are that it will be more of a continuation with the sector leadership remaining the same rather than anything materially different.
Right. Trideep, it appears that the way, the first file which Prime Minister actually signed after taking office was towards the agri and rural side. I want to understand, and of course, the small borrower universe got very excited. The lenders which cater to the small borrower got very excited. I want to understand, in your portfolio, would you be taking a relook at how the bottom of the pyramid, the suppliers there, be it consumer durables, retailers, lenders, who actually up till now were a distressed lot to a certain extent, their fortunes are likely to get reversed in this new term because the focus of the government will go there. How are you looking stocks in that area?
The great spot, Ajay. Over the last 3 to 4 months, we've actually added to what you describe as the rural part of the pyramid or the bottom end of the pyramid, both on the FMCG side as well as a couple of names on the consumer discretionary side. Not that we had an idea about the elections, but more so because the forecast were that the monsoon is likely to be better than normal. And if you look at the stretch of valuations, on one side we have the industrial names which were kind of which had done quite well, and on the other side you had the FMCG or some of the consumer exposed names at 3-year low relative valuations. So we took advantage of that and kind of have added to actually FMCG and IT over the last 3 to 4 months, and hence in that context, when we see these announcements like this is likely to be helpful, particularly to the rural end of the pyramid. But also, mind you, if the monsoon comes out better than expected, then I think it'll add fuel to the fire, and that segment of the market which has been reeling would actually kind of see some light of the day, which have some positive days.
Especially, I see names like Coforge, and I'm taking this name only for illustration purpose. But this category, Coforge, Persistent, KPIT, the mid-tier, IT companies which are also aggressive on M&A, have shown much higher growth and profitability. And today I was reading, the commentary from one of the Coforge senior management in one of the pink papers, confidently claiming that they will outperform their peers as far as growth is concerned. How are the valuation of this universe? I want your thought of the valuation and the earnings argument in terms of growth which it offers.
Yeah. So I think on IT side, I would say first of all, earnings are bouncing around the bottom. We don't expect miracles over the coming 2 quarters, but I think as you move towards next calendar year and practically from next fiscal year standpoint, when global recovery will take shape in some form or the other, you could see a bit of gradual rebound in earnings post a normalization in the post-COVID era. So what I mean is, during the COVID era, there was clearly amplified spending in IT, which got normalized in the subsequent 2 years coming out of COVID, and now we are kind of at the fag end of that. And as global recovery takes over, you would see that IT spend over the next 9 to 12 months would actually gradually recover. Hence, earnings are actually bouncing around the bottom. That's one part. The valuation part, I think, post the last result season, the valuations of some of these mid-tier IT companies have also corrected and are more reasonable now relative to kind of rest of the market. So that's another area where we have added over the last 3 to 5 months, and we still think that, again, overall, with the expectation that nothing really great shakes will happen in the next couple of quarters, but over the next 4 quarters, things will actually turn for the better than for worse.
I see you've also added some of the names such as Havells, Dixon. And what is common is that I want to understand consumer durables, air conditioning. There's a massive mismatch. Consumer durables is taking off. Bharat, make in India kind of opportunity. But do you see electronic manufacturing also like a opportunity which is a prolonged opportunity? And but up till now, the margins have been very low on this side. If volumes pick up, do you expect margins also to improve?
My sense is that, I mean, that's what I meant earlier, that if you look at, the end industry for these segments that you mentioned are ultimately the bottom end of the pyramid or middle end of the pyramid, so to speak. And we have added both on the FMCG, on the staples side and on discretionary side over the last 3-6 months in this area. I would say that overall, if you ask me, over the next immediate 3 years, it is more a growth opportunity than a margin opportunity. Over the next 5 to 10 years, as the companies who are currently operating probably at the lower end of the value chain migrate to slightly higher end, that's when you will see margin shift stands to happen. I think the first anchoring, which seems to be happening in the case of EMS as a sector, is probably at the lower end of the value chain, where India is just about establishing its presence as a replacement of maybe China plus one and a few other smaller countries, to say that we can also execute with zero defect and establish themselves in the mind of customers. This is what happened in IT services around about 99, 2000 at the time of Y2K. Subsequently, as the companies went up the value chain, whether it was at that point in time, package implementation, consulting and whatnot, margins started to look up. But that happened over a period of time. That phase for EMS is slightly away. At the moment, I think over the next 3 to 3 years, if I may say that way, it'll be more a strong growth opportunity, and it'll be an important part to own and to be a part of this ride, as long as the company makes cash flows.
Right. Fair point, Trideep. That's an important point. What are your thoughts on some of the deep, kind of auto ancillary players which are doing, higher end manufacturing for auto ancillary? Surely Bosch is one. Minda recently did a massive tie-up for EVs and the stock got re-rated. But the larger point which I want to understand from you is, one is, higher end auto ancillary where the manufacturing capability and design is higher. And then there's the lower end commodity type of auto ancillary. Which end do you think would see higher earnings growth and better valuations over the period of time?
Great question. Though I would slice the auto sector in a slightly different way, and let me take you through that. I would slice it between OEMs and ancillaries and domestic and overseas, and basically between EV and non-EV exposure. If I were to look at it from the first, if you look at my positioning today, I would be more positioned towards domestic, two-wheeler, OEMs rather than ancillaries. That is, of course, driven by my view that global growth has been difficult to come by, and in the meantime, a certain segment of OEMs in the local market, like two-wheelers, etc., have been in the pink spot. Going forward, if we were to look at next 12 to 18 months from an auto ancillary standpoint, as the global growth improves, I would look to take exposure towards companies which are indifferent between indifferent or positively impacted by the EV transition, rather than at the commodity end of the spectrum, even though they might have valuations in their favor. So while we can't go stock specific, I think though that's broadly the framework that we are used to kind of navigate through the auto space, it's more stock selection driven rather than any top down thinking, if you ask me.
Right. Trideep, through your large cap and mid cap portfolios, how are you getting a sense from the managements, and what is the earning visibility on a blended basis for the next 2 to 3 years? One of our friends, Gautam Dugar, just put out a note this morning highlighting that the corporate profitability trend has only gathered pace. Last 3 years it has been rising sharply and is likely to improve next 2 to 3 years. Are you getting the same reflection when you speak to the managements in your portfolios and look at the numbers?
Let me put forward my thoughts in this direction. We are basically in the third or fourth year of economic recovery, if you recall, post the COVID era. Now, generally what happens is the economic momentum, as reflected in growth of large, mid and small cap companies, starts with being narrow and mostly with large caps. And as the economic recovery takes hold, it becomes more broad-based and moves towards mid and small caps. Now, that is where we are today. And hence, directionally, I agree with the statement that you made that economic recovery and the earnings momentum is getting more broad-based, and hence being a lower base is higher in the case of mid and small caps than what you see in large caps. Now, if you add on top of this the recent election outcome, we now have decent visibility over the next 5 years with regards to how the policies are going to look like. And it looks like it's going to be more of the same with a bit of tweaks rather than any material difference. So in those circumstances, I would suspect that the growth in mid and small cap space will likely to continue to be robust and higher than that of large cap. So which boils down to the question that while valuations are on the higher side in mid and small cap, my statement has always been that growth is also materially higher in the place of mid and small cap. So one has to be selective within mid and small cap while stock picking rather than completely avoid that space would be my way of going about not just the growth but also stock picking within that segment.
Right. All right, Trideep, we'll let you go on that one. Thanks so much for joining us. Always enjoy our conversations.
Pleasure.
That was Trideep Bhattacharya, CIO-Equities at the mutual fund company, Edelweiss, of course. We'll take a short break.